Good morning, ladies and gentlemen, and welcome to the PARITY Group PLC interim results meeting. Throughout the presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Matthew Bayfield, CEO, and Mike Johns, CFO of PARITY Group PLC. Good morning.
Good morning, Paul. Thanks very much. Good morning, everybody. Thank you for your time this morning. We appreciate you listening to what we have to say. Just wanted to start by giving you a little bit of a summary of what we're going to cover today. The first thing that we wanted to talk about was we have seen a return to a more active market. And the reason I find that rather amusing is obviously today's news may change that. So we are looking at the markets as it stands today and trying to assess exactly what that's going to mean for us. But certainly from June onwards, we saw an uptick in business, particularly from our friends at the public sector. The second headline to make clear is that we have effectively completed our transformation. So it's been an 18-month journey and we've seen gross cost savings to the effect of £4 million per annum. And after reinvestment in key hires, marketing and a new IT system, we are at 2.4 million of net cost savings. And we'll go into more detail for you later on each of those. Our 2020 full year adjusted profit, PBT, will be similar to that we achieved in 2019. And we have to say that given the current climate and the pandemic, we consider that to be a big win, even though it isn't the growth that we were all anticipating at the start of the year. And lastly, as a headline, our net cash balance as at the 30th of June was just under 0.65 million, which is up on the same period last year. So quickly into some detail for you. In terms of our business model, we have fully transitioned into being a digital first business, and that's reflecting what clients wanted. The key tenet that we set out was to get close to our clients, to build stronger relationships with our clients. And we have seen those clients respond with demand in the areas of cybersecurity, digital transformation, and virtualization. And I'm sure you can all understand that as businesses have had to instigate remote working and have deliver their products and services online, these areas are in high demand, and that's something we're looking to take full advantage of. To that end, we're very focused on growing profitably, and that's something we've been talking about for a while, that we're moving away from low margin commoditized business into higher margin delivery of services and products that clients really value. And that plays to our strengths historically in data and digital transformation. So if I was to summarize that for you, I'd say we're rebuilding PARITY's reputation as the leading UK experts in data and digital skills. In terms of the operating model to support that ambition, well, we've delivered this cost saving over this period of time, and it's led to a far more flexible outsourced operating model. And what we mean by that is our cost base is now a lot more flexible and can be moved up and down depending on the top line and how we're growing as a business. That gives us a new system and a new set of processes that have enabled us to run at a far more lean rate, and we are the right size business for the amount of money that we generate. In terms of where we're at in the journey, I'd say we're effectively complete. We have probably another month of embedding the new systems that we've got in place, but we see no future material underlying costs anticipated in H2, and the systems are all up and running and the people are all in place. So at this point, I would say we have effectively completed the business transformation. We will be experiencing and enjoying the full impact of those savings in the full year of 2021. So to summarize that, the transformation we've been through has delivered a leaner business and it's able to deliver far higher margin work. And I guess you could say in an operational sense, we're geared in such a way that we can grow at the top line without having to have associated growth of the cost base. I'm just going to hand you over to Mike now, who's going to go into some detail about the financial performance and the results so far.
Hi, good morning, everybody. I wanted to start by just talking through a couple of the key reporting metrics. We are looking to focus on our net revenue. This is a better measure, we believe, for the business of the income derived by the business for the service that we deliver. What that means is for recruitment services, that's the net revenue defined as the margin earned on the placement of contractors. And for the other services we provide, then it is the total fees earned. And going forward and today, we'll be reporting based on that net revenue. In addition, our profit measure that we look to report on is adjusted to exclude items classified as non-underlying. We believe that that provides a more effective measure of the operating performance of the business. And just to clarify, previously we've used non-recurring, and all items classified as non-recurring would now also be included within the definition of non-underlying. Just moving on then to the results in a bit more detail and looking at net revenue for the first half compared to the second half of 2019. Revenue or net revenue was down to 5.3 million. That was 0.7 million lower than the second half of 2019. Two key factors involved in that. The primary one being the planned wind down of the Scottish Government agreement, which had lower margin business. That was a decision taken in 2019, and we're seeing the last effects of those come through in this half, and then in the second half we'll see some small residual amounts come through. The other impact was, along with every other business or most other businesses, we've seen a small impact from COVID-19 of around about 300,000 from our existing clients. And those are the two key factors in the reason why net revenue has reduced from 6.1 to 5.3, half on half. Looking at our revenue by sector, key to understand the performance of our business and also how robust our business is, that nearly 80% of our net revenue comes from the public sector. And we have clients across the board in the public sector, although there are two key areas which are education and central government, where we have a number of suppliers. In the private sector, our exposure is mixed, although retail, where we have a very limited exposure of only 25%, and obviously those are the hardest areas, or have been the hardest areas hit by COVID, but manufacturing and services have been relatively good to us during that period. Summary of the income statement then. So revenue, gross revenue, as we talked about before, half one 2020 against half two 2020 is down, but we focus on net revenue that I've described before as being 700,000 lower. The impact of the business transformation directly on our operating costs, half to half, has resulted in a 1 million reduction in our operating costs, which is more than offset the reduction in net revenue. Finance costs are slightly higher with some additional administration costs, particularly around some valuations for pension. But what it's meant is an adjusted profit in the first half of 61,000, which compares very favourably to an adjusted loss in the second half of 2019. Non-underlying items in the period of 444,000 are primarily related to employee costs, as we've changed the focus of the business so that more of our employees are focused on frontline and less on backline, as we've implemented new systems and improved our processes in the back office. Just quickly on the balance sheet, summarising that. We have a positive net cash position before lease liabilities of 650,000. That is against 1.4 million at the end of last year, and I've got a slide that will show you the change in that shortly. We have continued with what is a relatively exceptional cash collection performance. Despite COVID, with our clients in the public sector and very good relationships with our clients in the private sector, we've actually maintained an average debtor performance over the period of 14 days, at the end of the period of 14 days. That compares very favourably with the same period last year when it was 16 and the year end when it was 12. Our defined pension liability, or defined benefit pension liability, has reduced by 400,000. That's due to a combination of investment performance and a change in the discount rates used to calculate the pension. But that means that we now have a pension liability on the balance sheet of 500,000, down from 900,000 at the end of the financial year. Our lease liabilities, calculated under IFRS 16, have increased during the period. This is down to the fact that we have signed new leases in London and Edinburgh. They're both short-term serviced offices, and that's just an accounting treatment in terms of increasing those liabilities. So I mentioned that I would focus a little bit more on cash, just providing here a cash bridge going from 1.4 million that we had at the end of last year to the position we have now of 650,000. Our operating cash flows generated 350,000. We had a net working capital deficit of 530,000. The majority of that was related to timing on payments that we make to our contractors. We make most of our payments to contractors on a weekly basis, and the payments, how they fall against the end of the year or the end of the period, and we've made more in the current period that we're in. So the last of December payments fell over into January, and hence that improved our position at the end of the year, and that's been unwound now. So that is normal working capital movements. We paid out through just under 400,000 in relation to our non-underlying items, and we've got defined benefit pension costs in the period of 140,000, a combination of contributions to that pension that we've planned to make, and also administrative costs, and then a small amount of bank interest. That takes us to our net cash position of 650,000 for the end of the period. So where that brings us to as a business at the end of the first half of 2020, as Matt said earlier, is a more agile operating model. Not only have we reduced our costs, but we've been able to make some significant investments in the business. We've invested in new cloud infrastructure and digital backbone, and that's a 300,000 investment to date. That's allowed us to streamline our back office. It's also made us more resilient and able to work during the current climate, with our employees able to work flexibly and remotely where necessary. We've also strengthened our client and community teams and recruited leading data experts, placing more of our people at the front line and utilising the fact that we've made savings in the back office. We've moved where we can, support services to being outsourced, and also into flexible office spaces, which I've mentioned before. So we have a very flexible operating model. And what that's meant is that over the last 18 months, we've reduced our operating costs by 2 million. The flexible and lower cost base, we can leverage that to deliver higher margins going forward. And we've got a streamlined back office, as I said before, and we've invested in frontline delivery. And that means we've got a business infrastructure that supports flexible and remote working and has adapted very, very well to the new COVID world without disruption. I'll now hand back to Matt, who will talk to you about the outlook for the business.
Thanks, Mike. I thought it was worthwhile just reminding you all of our ambition. We set out when I took over about 18 months ago to have a strategic goal, and that goal was to equip clients with the data skills they needed in order to make sound, bold commercial decisions. And that hasn't changed, and we haven't wavered in that. And that resonates very well with both our public sector clients and our private sector clients. The way that we internalize that for investors is our financial ambition, therefore, is to grow the profitability that we have. It's obviously been a business that's been able to do a large turnover, but it hasn't been very successful at converting that to the bottom line. And that's really been our focus. And certainly when we set out for 2020 back in 2019, we were very much looking forward to and confident that that would be delivered. The way that things have transpired has obviously been affected largely by a pandemic. We know that it's difficult to show what a like-for-like comparison would be with how vastly different things had worked. But what I was hoping to show you here was the impact on our unadjusted operating profit over the last 3 halves. And hopefully you can see clearly that we're heading in the right direction. Yes, revenue are coming down. And we anticipated that reduction in revenue as a runoff of the lower margin Scottish government work. So we were well ahead of that in terms of our cost saving. But we've been able to see an improved rate of operating profit and an improved rate of unadjusted operating profit. And as we head into 2020, in an unadjusted sense, we are back to being a proper profitable business, which feels very, very good given the current climate. And I have to call out at this point that that's largely due to the people that we have, and our people have been excellent at doing their jobs and staying motivated during what's been a very difficult time, and particularly our relationships with the public sector, which have gone from strength to strength. And I will talk a little bit more about the public sector in a second. In terms of giving you an outlook, therefore, it's a very interesting time to be providing outlooks. And I know that as an investor community, we're all very keen on being able to make predictions about the direction the business is moving in. And right now, I can tell you with certainty the shape of our business and how I feel about our proposition in the marketplace, but I can't situate that in a market that I feel I understand exactly how that's going to move. So things that we do know, what do we know? We know that we will be on or around the same level of profit that we made in 2019. And I consider that to be a big win in this year. We see continued growth in our public sector work. The G-Cloud and DOS, which are the big frameworks that the government uses to tender all of its major work, 1.5 billion was spent in 2019 on those frameworks. We're very well placed and are taking advantage of those frameworks. And I think you'll be aware that we had 2 wins during lockdown through those frameworks. One in cybersecurity, which is for the Northern Ireland Cooperation Overseas Board. And that's particularly good news for us, as it's the first win as part of a partnership building out our cybersecurity credentials, and in fact being the first partner of the only cyber gym in Europe. And I see cybersecurity as an increasingly important area of development for us, both as a business and as a country, as we move to understand the risks associated with a distributed workforce. The second win that we had through that, which we announced, was the Scottish Government DPS framework, which is a digital protectorate. And we were fortunate enough to win placements on lots 1 and 3. We were already on lot 2 of that. And what that gives us is a high throughput of business for contractors in specific digital and data positions. And again, that's a very encouraging win for us, as it positions us much more in the higher end delivery than it does in any kind of lower margin work. So as I've said, the business itself is in great shape, right? We've taken a lot of cost out. We are operationally geared correctly. We are right sized. The proposition that we have is resonating very strongly with the market. Those 3 areas, cybersecurity, digital transformation, and virtualization, are growth areas. However, I think it's important that we recognize the macroeconomic impacts of this pandemic. And I don't feel anyone is confident in understanding exactly what direction that's going to play out in. My experience has been that new business has suffered most. And I would say, realistically, new business suffers because it's something that requires a face-to-face meeting. I can't actually think of any new business with an entirely cold client, somebody that you haven't worked with before, that hasn't had some kind of face-to-face interaction up front. So I think that's a problem predominantly in the private sector, winning new clients. And until such times as we're able to return to face-to-face meetings, or we find a different way of doing that, I think we'll continue to struggle in that area. However, public sector continues to grow. We don't see any tightening of purse strings. And in fact, we see an increase in expenditure, we work for the Office of National Statistics, and during the pandemic, we were working somewhere in the region of 30 to 40 roles for them as they were piling more people into assessing the impacts of the pandemic. And even at a local government level, we're seeing a rush to be able to pile in to data and digital specialists who can help them understand the impact at a local level on the economy. So the government work that we have gives me an awful lot of confidence and comfort that we can anticipate and look forward to anticipating a significant uplift in net profitability next year. So as we both said, Mike and I, we are operationally geared to take advantage of the fact that the business is right-sized and streamlined, which means that new business wins and new net revenue will flow through in a far more direct fashion to the bottom line. I just want to leave you with that as an overarching ambition for the business for next year, obviously caveated by the market conditions that we all find ourselves in. So thank you very much for your time. I'm just going to hand back over to Paul, and then I think we're going to answer some questions.
Fantastic. Matthew, Mike, thank you very much for updating investors there. As Matthew says, ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just type in the question and press send. Just while the company take a few moments to review those investor questions submitted already, I would like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. And lastly, before I hand back to Matthew and Mike, I would like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you will be redirected for the opportunity to provide that feedback in order that the company can better understand your views and expectations. Just a couple of seconds after the end of the meeting, it will pop up in front of you. Matthew, Mike, perhaps we could, as you say, move on to the Q&A. If I could perhaps ask you to read out the question before answering, I think that'd be really helpful for investors, if that's okay.
Yeah, sure. Okay, we've got a few questions here, not very many, but I shall attempt them. The first question, have we taken all of the cost out of the business, and do we foresee any future cost savings? The answer to that's pretty straightforward. Yes, we have taken all the costs out of the business. We are right-sized, and we do not foresee any future large material cost savings. Hopefully that answers that one. The second question is, how will the business respond to a tightening of purse strings within the public sector? I have to answer that in the negative, which is that at present we see the opposite. Particularly in the areas that we serve around data and digital specialists, we see an increase in expenditure. In the public sector, we don't see a decrease. The attempts that the government may or may not make to look at its expenditure, I think, will not affect those areas in quite the same way as they will other parts of the government. The next question is, how are we benefiting from our new non-exec director, which is Jerry Brandon? He's been a breath of fresh air. So Jerry's arrived on the board and has brought new perspectives and new ideas to how we can help grow the business, as well as look at ways that we can publicize and become much more interactive with our investor base. So we're particularly pleased with the impact that Jerry's already starting to show to the board. The last question is, back in April, we had consulting wins with the like of Primark, NHS Digital and BAT. Apart from public sector announcements, are there new wins in the private space? As I've highlighted, the biggest COVID impact for us has been in new wins in private sector. So no, we do not have any new private sector wins so far this year. We have conversations in place with lots of different organizations. Our pipeline is looking extremely healthy. Getting somebody over the line and getting them to commit to a project in the private sector is particularly difficult. What we're hoping to see is those conversations come to fruition either in the late part of this year or the early part of next year. To be clear, if we haven't made it clear, we've hired 7 new people during lockdown, the majority of which have gone into new business, and they are building these conversations and these relationships with potential clients, but actually getting it across the line when you can't have a face-to-face meeting seems to be the big hurdle. So hopefully when we can get past that hurdle, we can look forward to seeing that area of the business start to pick up again. That's all the questions I have, Paul.
That's fantastic. Thank you very much. And do submit your questions. If there are any more that come through just while we're closing up, obviously the company will review all of those that come in. Matthew, I know you have sort of just given us some, but just to wrap up, just a couple of words, please. That would be great. And then I can redirect investors for that important feedback.
Thanks very much, Paul. So just in closing, everybody, we are looking forward to and expect a far more profitable 2021. We are pleased with the impact that we've had this year in able to maintain profitability despite COVID and the relative impacts of that. And I feel very strongly that the business is now in the right shape that it needs to be in, with the right proposition, so that clients will fully take advantage of our services. So, you know, it's a funny tightrope to walk at the moment between optimism and realism, and trying to understand the full impacts of a macroeconomic situation. But as a business, I'm very, very happy with where we are, and very much look forward to reporting next year increased levels of profitability.
That's what we like to hear. Thank you very much. So thank you, Matthew. Thank you, Mike, for updating investors today. As I said before, could I ask investors not to close the session, as you will be automatically redirected for that opportunity to provide your feedback. If you've accessed this meeting from our website, the feedback page will appear in front of you. If you've accessed from the link sent by an email, you'll be asked to log in. It will just take a couple of seconds to pop up in front of you. So it would be great if you could fill that in. So on behalf of Parity Group PLC, Investor Meet Company, Matthew, Mike, thank you again. That concludes today's presentation. Thank you for updating investors today.